Wait, you're not still chasing the highs blindly, are you? Seriously, did you really think the Nikkei would just keep pumping past 50,000 without a pause? Or worse, are you watching from the sidelines, thinking you already missed the boat while the smart money is gearing up for the real move? Because here's the harsh truth. What you do right now, in this quiet before the storm, could decide whether you ride the next wave or get wiped out by it. This isn't about being some Wall Street prodigy or having perfect timing. What separates pros from amateurs is simple. They don't predict, they prepare. With probabilities, not gut feelings. And you can do the same. Yes, you. Even if you've only been trading for a few months. It's not magic, it's just strategy. Imagine this, you wake up. BOJ just dropped their decision. You already have your playbook mapped out. Where to take profits, where to hedge, when to buy the dip. No panic, no noise, just precise execution while others scramble. That's the level we're talking about today. I get it. You saw the Nikkei cross 50,000 and your brain screamed, it's too late. Then the next day, it dipped and you thought, I knew it. It was a trap. Now you're stuck in no man's land, too scared to buy, too proud to sell. But let me be clear, that's not your fault. It's the market playing tricks on your psychology. The good news, there's a way out if you stop thinking like the crowd. This is just noise. I'll wait till after BOJ. I'll decide when it's clear. Sound familiar? Those aren't strategies. They're excuses wrapped in fear. If you want to level up, you've got to make decisions when others hesitate. Now is that moment.
You don't need to be a fund manager. You don't need sucks monitors and insider info. I started with a phone, a chart app, and a notebook. But by thinking in scenarios using macro signals and respecting technicals, I turned that into a reliable system. And today, I'm handing you the same blueprint.
What I'm about to show you isn't some recycled CNBC headline. It's a strategy built from real-time data, market structure shifts, and BOJ sensitivity. This isn't for everyone, but if you're ready to trade like the top 10%, stick around. The game's just getting started.
Step 1. Think in probabilities, not predictions. Conclusion. The most effective way to survive uncertain markets is to stop predicting and start preparing with probabilities. Successful traders don't ask, what will happen? They ask, what's likely to happen? And how do I position myself for each outcome? When you're facing macro events like a BOJ meeting, it's not about being right. It's about being ready for all three paths, bullish, neutral, or bearish. Reason. The market hates uncertainty, and right now, we're heading straight into a fog of it. You've got a BOJ policy decision within 48 hours, runners, mixed signals on fiscal stimulus, yen strength returning just as stocks test all-time highs. No one knows how this will play out, but here's the key. You don't need to know. You just need a framework, a way to allocate risk based on odds, not emotions. That's what separates disciplined traders from hopeful gamblers. Example, here's how that looks in real numbers. Ball case. 40%, the BOJ keeps policy steady, downplays inflation risks, and the yen stays soft. In this case, the Nikkei could retest 50,550 and push toward 51,000, or even 51,500, led by semiconductors, retail, and AI-related names. Low and GL numbers, vice case, 45%. The BOJ stays neutral, guidance is balanced, and the market consolidates. We likely chop between 49,800 and 51,000, with dips being bought and rally sold, a classic post-breakout base. Bear case, 15%. The BOJ turns unexpectedly hawkish, or the yen spikes below 151. That cracks the 50,000 floor, opening air pockets to 49,500, even 48,800 in a sharp unwind. By assigning probabilities, you remove emotion from the equation. You're no longer guessing, you're strategizing. Samudari, thinking in probabilities is your edge. It gives you confidence when the crowd is confused. It allows you to make measured moves rather than emotional ones. It prepares you to win no matter which way the market breaks. This isn't about calling the top or bottom, it's about building a strategy that wins over time. It's about building a strategy that wins over time, especially when volatility hits. So stop gambling on one direction, start preparing for all three. Step 2. Scale out, don't panic sell. Conclusion. The smartest way to secure profits in a heated market is by scaling out gradually, not by panic selling everything at once. When the market gets overheated, going all in or all out is emotional. Professionals take profits in steps, manage risk in layers, and leave room to re-enter if conditions improve. This approach lets you stay flexible, not frozen. Reason. Why scale out instead of dumping your position? Because volatility around major events like the BOJ can whipsaw prices. One headline, one unexpected tone shift, and the market can spike or crash. If you sell everything too early, you miss potential upside. If you hold everything too long, you risk giving back gains. Scaling out allows you to lock in gains, manage drawdowns, and still participate in upside if the market resumes its trend. It's not about perfection, it's about protecting progress. Example, let's say you bought into the breakout around 49,500. As the index surged past 50,000 and hit resistance near 50,550, a stepwise strategy might look like this. Run fortsätter på 12 och andra sidan mini. Run fortsätter på 12 traffic. Foto den EP 100. Rundfopsesarotolvo anbokshokshale, Axakeso Morga Kogisbeer, Doshazamai modelik bite. Instead, they build in exit ladders based on technical zones. Key support levels to watch: 50,000 psychological, 49,800 recent base, Rundfopsesarotolvo, 30,000 Solaris Kamgetting, Laced technical floor. Let's say you bought into the breakout around 49, Adek 30 Mutal. Summary: scaling out isn't weak, it's strategic. It gives you control in chaos. It turns profits into cash while keeping you in the game, and it prepares you to act, not freeze, when volatility hits. Panic selling is a reaction. Scaling out is a plan. The question isn't whether to sell, it's how to sell smart without losing your edge. Step 3. Read the BOJ like a map, not a monster. Conclusion: don't treat the Bank of Japan like a market killer. Treat it like a navigation tool. Most retail traders panic around central bank events. But real pros? They view policy meetings as signposts, guidance to position around, not run from. Your job isn't to outguess the BOJ. It's to build trades that make sense regardless of the outcome, based on what each decision unlocks. Reason: the BOJ doesn't have to raise rates or shock the market to matter. Sometimes it's the tone, the guidance, or even what they don't say that moves FX and equities. For example, if they warn about asset overheating, that might signal a shift toward tightening. If they highlight yen weakness as a concern, that could push USD JPY lower. If they say nothing at all, that silence might support the bullish base case. In each case, the reaction is different, but predictable if you know what to watch. This is about reading the language of risk, not guessing policy outcomes. Example, let's break it down. Scenario 1. The BOJ stays dovish, offers no surprises, and the yen remains weak. Nore, stocks rally, especially exporters and semis. Nore, seek rally session 250 plus in work size. Lora kamochat yen prime 100 fell for 1 pounds not 3. Scenario 2. The BOJ sounds slightly hawkish or cautious on asset prices. Nore, yen firms slightly. Equities stall. Range trade between 49,800 to 51,000. Yen strengthens fast. Nikkei drops below 50,000. Risk testing 49,300 or lower. In all three, the path is different, but you're not guessing because you've mapped the outcomes. Samurai, the BOJ isn't your enemy, it's your catalyst. By understanding the likely market responses, not just the decision itself, you stay ahead of the panic, not trapped in it. The pros don't fear policy, they prepare for it. So read the BOJ like a trader, not a headline chaser. Use their signals as a roadmap and let the crowd react while you execute. Step 4. Watch the mechanics, not just the headlines. Conclusion: what moves the market isn't always what's in the headlines. Sometimes it's what's happening under the surface. Index rebalancing, sector rotations, and passive flows. If you're only focused on macro news, you're missing half the game. To stay ahead, you need to read market structure, not just narrative. Reason: headlines create noise, but mechanical flows from ETFs, index funds, and rebalancing often drive real price action, especially in Japan's equity market. When stocks like Nasdaq are removed from the Nikkei and replaced by names like IBDEN, it's not about earnings or news, it's about index math. Funds that track the Nikkei are forced to buy and sell, creating real pressure, regardless of fundamentals. This means short-term price moves can be misleading, unless you understand the mechanics behind them. Example, take what just happened. Nikkei plunged on news of a potential delisting and removal from the Nikkei 295. That created mechanical selling pressure not based on fundamentals, but index reshuffling, IBDEN. The replacement saw increased buying from passive flows. Not because of sudden optimism, but because it's now part of the index. These shifts also ripple into related industrial names. And during BOJ week, sectors like defensives or high dividend stocks often see inflows if the yen strengthens. So while the headline says Nikkei dips on BOJ fears, the real reason could be mechanical positioning, flows, and structure. Summary: if you want to trade like a pro, don't just read the news. Read the tape. Understand what's structural, what's sentiment, and what's simply forced flows. Market movement isn't always emotional or macro-driven. Sometimes it's just math. And when you see it clearly, you stop reacting and start anticipating. Final message. So here's the truth. 50,000 wasn't the end. It was a stress test. A test of whether you could stay calm. While the hype cooled and the uncertainty ramped up, most traders get shaken out right here. Not because of bad fundamentals, but because of bad psychology. But if you've watched this far, you're not most traders. You're here to build conviction, think in scenarios, and execute with discipline. That's the difference between chasing momentum and becoming a market tactician. If this video helped you see the market with more clarity, hit the like button. It really helps the channel grow. Got a question or want me to break down another topic? Drop it in the comments. I read everything and I might build a full episode around it. And remember, this channel delivers research-grade insights built from real data and first-hand analysis, not headlines, not hype. So if you're serious about leveling up your strategy, subscribe now and study these videos more than once. Because most people watch once and forget. The winners, they replay, study, and execute. Be the few who do. Recap what you learned. Let's lock it in. Recap. You learned to think in probabilities, not predictions. You saw how to scale out and protect profits without panic. You understand how to use the BOJ as a roadmap, not a monster, and you now read market structure like a pro, not just headlines. This is your trading edge going into BOJ week and beyond. Thanks for watching. This is Japan Market Samurai signing off. Stay sharp, stay disciplined, and I'll see you in the next one.